Welcome to Talk Tickers. All right, today we're digging into Laird Superfood. That's ticker LSF. They just dropped their Q2 earnings, and, well, it's a classic Wall Street puzzle. On paper, things look pretty good, but the market's reaction? An absolute bloodbath. Let's get into it.
So, looking at the headline number, everything seemed fine. I mean, they delivered a solid beat on earnings per share. Wall Street was expecting a loss of 6 cents, but LSF came in with a loss of just 3. So, better than expected, right? That's usually a good thing.
But yeah, the market told a completely different story. Despite that earnings beat, the stock just got hammered. We're talking a drop of over 15% the very next day. And check this out, it was on a huge spike in trading volume, so a lot of people were rushing for the exits.
So the big question is, what gives? How can a company beat earnings estimates and still have its stock crash and burn? Well, that's the disconnect we're going to unpack. Let's dive in and see what the market saw that the simple headline numbers didn't show.
Okay, first things first, let's lay out the headline numbers from the quarter. And right here, this is where the cracks really start to appear. Okay, so revenue growth, a very impressive 20% year over year. That looks great, but it actually came in just a hair shy of what analysts were expecting. And here's the real kicker. Gross margin. It contracted by 190 basis points. For you and me, that's a 1.9 percentage point drop from last year. And trust me, that's a number the street was watching like a hawk.
This really sets up the central conflict here, right? It's the classic story versus stock price dilemma. You've got management telling one story and the market, well, it's screaming another one.
So on the earnings call, you had the CEO, Jason Veeath, painting a really rosy picture. He was talking up their strong momentum, saying, hey, look, we're one of the fastest growing food companies out there, especially in this tough environment. He was really trying to frame them as a big winner.
And here's what the market had to say about that. A brutal, sharp sell-off. I mean, look at that drop. This wasn't just some minor profit-taking. This was a massive vote of no confidence from investors, basically ignoring everything that optimistic C-suite commentary had to say.
All right, so let's get into the why. What's behind all this fear? To really get it, you have to understand the company's core strategic shift. They're pivoting hard into wholesale.
Yeah, management is going all in on the wholesale channel. We're talking about getting their products into big grocery stores, club stores, you name it. And, in one sense, it's working. Wholesale has exploded to make up nearly half of their total sales. That's a huge shift from where they used to be.
Now, this is where it gets really interesting. Look at the massive difference in growth here. Wholesale is just on fire, surging 47% compared to last year. But their e-commerce business, their original bread and butter, the high-margin, direct-to-consumer stuff, it's basically flat, just 2% growth. It's completely stalled out.
And therein lies the problem. There's always a catch, isn't there? While this big push into wholesale is driving that flashy top-line revenue number, it's coming at a huge cost to profitability. See, wholesale is just a lower-margin business, and that big shift in their sales mix, yep, that's the main culprit behind that 190 basis point drop in gross margin we talked about earlier.
And it doesn't stop there. On top of this margin-crushing mix shift, management also laid out a whole laundry list of other headwinds. They're getting hit with inflation on key ingredients like coffee and coconut. They're dealing with tariffs. There was even a cyber attack on a distribution partner that's causing headaches. And, of course, the whole e-commerce world is just kind of sluggish right now. So you can see why investors are getting nervous as these risks just keep piling up.
But here's the thing. Even with all these problems stacking up against them, management got on the call and confidently reaffirmed their full-year guidance. This was a really critical moment, a real line in the sand kind of statement.
So they're still projecting this really strong 20 to 25% sales growth, with gross margins holding up in the upper 30s and even hitting break-even on an adjusted EBITDA basis. But you look at that stock chart, and it's pretty clear the market is saying, no way, we just don't believe you. The credibility of that guidance is now seriously in question.
Okay, so let's put it all together. What's our take on LSF from here? And what should you be watching for in the next quarter? It really all boils down to this one central question. Can that massive growth in wholesale generate enough actual profit dollars to make up for the hit to their margins and the fact that their e-commerce engine has stalled? That is the bet you're making if you buy this stock today.
So you've got your bull versus bear case, right? The bulls will tell you, hey, look at that 20% growth. The wholesale strategy is working, and management just told us they're going to hit their numbers. The bears, on the other hand, and the market seems to agree with them right now, are saying this growth isn't high quality, it's killing your profitability, and we just don't believe that guidance is realistic anymore.
So
For us, given the market's very clear vote of no confidence and all those risks to their margins and guidance that are just stacking up, our rating has to be underperform. It just feels like the path for them to actually hit their full-year targets is getting narrower and narrower.
All right, so for our outrageous but plausible trade idea, the thesis is pretty straightforward. You're betting that these margin pressures and credibility problems aren't going away anytime soon. The way to play that? You could look at long-dated put options. Basically, it gives you a way to profit if the stock continues to fall, which could certainly happen if the company's eventually forced to cut its guidance in Q3 or Q4. And after a report like this, that feels like a very real possibility.
And that's our breakdown of the puzzle that is Laird Superfood's second quarter. We'll definitely be watching next quarter to see if they can thread that needle. And as always, remember, this is for informational purposes only and is not financial advice.